Hi guys, Jared Johnson here. We have something we need to look at in the stock market. This past week in Jackson Hole, Powell and the Fed has turned dovish and signaled more rate cuts. What does that mean for us? And how has that played out over the last 20 or so years? This is a great opportunity to have a look at the historic context of what has happened in the last 20 years of rate hikes and rate cuts and all the stuff that the Fed loves to do. There's definitely some historic precedents here that we need to look at, so let's dive right in. Let's start by looking at the early-ish 2000s. Now, we had the big dot-com sell-off. There were big rate changes that happened there. Let's start kind of a calm period, 2004 to 2006 rate hikes. We saw 17 hikes in this period, and this is a chart of the S&P over that period of time. 17 hikes, the interest rate went from about 1.25 to 5.25%. And you can see pretty business as usual. This was a very calm period. I remember trading through all of this. These were all 25 basis point rate hikes, 0.25% after over and over and over again. Very steady, very business as usual. That's one look. Let's have a look at the next rate change period. Not long after the rate hikes ended in 2006, there was a little bit of a calm period. Not for very long, because the rate cuts began aggressively. This takes us into the 2008-2009 Great Financial Crisis. There were 10 rate cuts. This went from 4.75% all the way down to about 1%. Now remember, this was very different than what we saw in 2000. There were rate cuts in 2000, the dot-com bubble, but there wasn't experimental program like we had in 2008, the TARP, and all the different quantitative easing strategies that we implemented at this time. So we see rate cuts into an aggressive market sell-off. The previous was rate hikes into a slightly rising market. Let's have a look at the next period. The rate cuts ended in about 2009. And there were no rate hikes again until the end of 2015. That's a very calm Fed. There was no changes in interest rates until 2015. Now, they were building up the balance sheet for sure, and they were getting very busy in that department, but the rate hikes began again over here at the end of 2015. We saw 9 hikes that took us from about 0.5%. So we stayed at these very, very low interest rates of around 0.5%, quarter to 0.5%, from 2008, 9 until 2015, at which time the Fed began to hike rates, and they went from about 0.5% to 2.5%. Now, all of those that were trading, you remember this period right here. This was getting into the latter part of 2018. This was September, October, November. And remember, the S&P sold off a pretty healthy amount, about 20% from low or from high to low there, until the Fed signaled that rate hikes would end. So the market was okay absorbing these rate hikes. We said, okay, we're going up from 0.5% to 1% to 1.5%, so on and so on. But at about the 2.5% mark, the market said, hey, enough's enough. And everyone started pulling out and panicking. We had gotten so used to cheap, easy money for several years. Keep in mind, we're talking 7-8 years that interest rates stayed pretty much on the floor. Housing market explodes, everything's going up, going crazy. And so it made sense for the Fed to start hiking rates again to get it off those ground floor levels. The Fed doesn't have much in the way of tools if interest rates are super, super low and something bad happens in the economy. Then they get in a bit of a situation, a bit of a pickle. So they need to get interest rates to a more comfortable space, which they attempted to do. So they raise interest rates to about 2.5%. The market decides it hates that, sells off December 2018 pretty hard. The last few months of 2018, we saw a 20% drop in the S&P. So what happens next? Let's have a look. Okay, on this chart, what we can see is here is the end of the 2018 rate hike period, December, right? And from there, we see the Fed says, hey, enough's enough. We're gonna cut rates. And so they signal a rate cut. This is, of course, December 26, 2018. A very memorable moment when the market bottoms out and takes off and runs like crazy. And this is simply from the Fed signaling that rate cuts are coming. that there's no more hikes. They pretty much reversed course. They said hikes are done, cuts are coming. Not just we're going to stop hiking rates and we'll see where things go. They said hikes are done, cuts are coming. And the first rate cut came here in July of 2019. And this, we saw 5 rate cuts. Now, this is a little bit of a specific period. We topped out at about 2.5% interest rates out of the Fed. But then, of course, we get hit with a bit of a panic over here in March of 2020, which, of course, COVID hits, and there's an emergency meeting, and there's 2 rate cuts in March, right? So rates go from 2.5% to 0.25% yet once again. We can see this emergency situation, which there were emergency situations in 2008. They had multiple rate cuts in the same month in 2008 as they did in 2020 due to COVID. So from there, where do things go? From the rate cuts that ended at the bottom of the market and in March and so on, and stimulus packages galore, the market runs like crazy. And where do we see things go from there? Well, we know that right about the beginning of 2022, right around January, the Fed finally says, hey, we've seen some high inflation numbers. We've shifted from this being transitory inflation to this being something more severe. If you remember, right around July of 2021, we had that inflation number, that CPI number of about 9%. That was crazy. We saw prices going through the roof all through 2021. Gas prices were crazy. People were unable to buy recreational anything because they were selling off the shelves immediately. Prices were just going nuts in 2021. The Fed tried to shrug it off as supply chain issues and transitory inflation and so on. And finally, at the beginning of 2022, right about here, that's about January 2022, they said, rate hikes are coming, folks. And the rate hikes came with a fury. They started in March of 2022. This was one of the most aggressive rate hike cycles in the history of the Fed. There were 11 hikes that took interest rates from 0.25% to 5.5%. We haven't seen a hike that aggressive in that short of a period of time in quite a while. So the rate hikes, these 11 hikes happened from about March 2022 to about July 2023. So we saw a good solid year and a quarter of rate hikes after rate hikes. And these were some of the biggest rate hikes as well. We saw multiple 0.5% hikes, 0.75% hikes. So when you start seeing 50 and 75 basis point hikes, that's very aggressive. And we, of course, saw the S&P sell off about 28% from the time rate hikes were announced until this low point here in about October, where the market had started to adjust to these higher interest rates. Now, something happened here that was a little bit unexpected. In the prior rate hikes of 2018, 2017, 2018 era, where we took interest rates from under 1% to about 2.5%, the market started to sell off and participants started to panic, saying we can't handle this is going to crash the market and so on. A lot of the same rhetoric was repeated in the 2022 interest rate hikes. However, that didn't stop the Fed. They were going for it. Nothing was going to slow them down, and they hiked rates like crazy. And the market surprisingly absorbed it, and we've stayed at these higher rates for quite some time. It's been a couple of years now. Yes, there are ancillary effects in motion, but for the most part, the market has been able to absorb these higher interest rates and handle it with some fashion. The rate hikes ended around July 2023. What happened next? Starting in about September of 2024, we saw some small rate cuts after some very aggressive rate hikes out of the Fed all through 2022 and the first half of 2023. Well, we started to see some small rate cuts towards kind of the middle to end of 2024. Rate cuts have happened very slowly over the past year, bringing us down about 1%. Went from about 5.5% to about 4.5%, give or take. And the market is kind of just trudging along. It's been one of the more inconsistent rate hike or cut cycles that we have seen over the last few decades. Typically, rate hikes will happen and they're very consistent and they go for it. Our most recent rate hikes were very aggressive, and rate cuts fairly consistent, and typically rate cuts are happening into some crises, right? We saw 2008, very aggressive rate cuts. We saw the end of 2018, the stock market sold off 20%. That's enough to get people panicked and worried. The Fed starts cutting rates into that period. And then, of course, we saw COVID in 2020 and the Fed cut very aggressively there. So what we have happening here is more rate cuts into all-time highs in the S&P. This has got people scratching their heads. Does the Fed see something coming that the rest of us see or don't see? Is this just a rate cut to balance things out a little bit? Rates were considered a bit restrictive for a while. And so is this trying to get things back into balance there? That is the big question. The reason that Powell said in Jackson Hole that rate cuts are coming and that they'll continue, because again, we've already seen a few small 0.25% rate cuts from about September 2024 till the present. They've been kind of inconsistent, and the message has been very inconsistent of maybe we hike rates again, maybe we leave them here for an extended period of time, all of that. Well, now the Fed has taken a very about-face approach and said rate cuts are coming, and there's big predictions of bigger rate cuts, and they're stating that the labor market is the concerning element here. So whenever there have been rate cuts into market highs, 2007, early 2020, it's been because there have been massive sell-offs in the market. 2018 was also a period of time that was a bit concerning. So the question I think we all have is, are these rate cuts going to do the opposite of what everyone has been talking about? We've been seeing a lot of chatter about rate cuts can happen, housing prices will go up, the stock market will go up, and so on. I look at this, if we just take history as the precedence here, I look at this as possibly something that maybe gives the S&P a little bit more boost, but over the longer term, I would be looking for some S&P selling here. I think that this is ultimately going to be a bit bearish on the stock market. I'm curious to hear your thoughts. I hope you find this helpful. Let me know questions, comments you have. Like and subscribe below. Let's see where this goes from here. Very exciting times. Good luck. Happy trading.